Your next car battery may depend less on breakthrough chemistry than on a fragile salt route most drivers have never heard of. Not a mine, not a gigafactory, a salt route. Here is the mechanism. A huge share of the world's battery-grade lithium begins as brine under the salt flats of Chile and Argentina, gets concentrated into lithium carbonate, moves through ports and oceans, and then is often converted again into lithium hydroxide in a refining system heavily concentrated in China. When that chain stalls, EV prices feel it. The thesis of this story is simple. The real bottleneck in batteries is not just lithium in the ground. It is the narrow and vulnerable route that turns brine into battery chemicals at industrial scale. And that route is exposed to water stress, shipping friction, refinery concentration, and spot price swings that can reprice an electric car long before a consumer sees any headline. Start in the salt flats. In Chile's Salar de Atacama, brine rich in lithium is pumped from underground aquifers into evaporation ponds. Under desert sun, water disappears over months, sometimes longer, leaving a more concentrated solution that can be processed into lithium carbonate. Chile remains one of the world's key suppliers, and Albemarle and SQM have been central operators there. Argentina is expanding too, with projects in Jujuy, Salta, and Catamarca. On paper, that sounds abundant. In practice, it is slow, weather-exposed, permit-sensitive chemistry tied to one of the driest regions on Earth. This is where the public story usually goes wrong. People hear lithium reserves and imagine a warehouse full of battery material waiting to be loaded. It is nothing like that. Brine lithium is a timing business. It is a water business. It is a conversion business. If the evaporation cycle slips, if impurities rise, if transport schedules break, the industry does not receive battery-grade input on demand like ordering screws from a catalog. It waits. I think this is one of the most misunderstood facts in the EV transition. We talk about batteries as if they were software scaling in the cloud. They are not. They are geology, chemistry, drought, ports, and vessels. And once you see that, the whole market looks less futuristic and more fragile. Then comes the first choke point: conversion quality. Battery makers do not just need lithium carbonate, they need consistent, high-purity chemical feedstock. Lower-grade material can be sold into ceramics or glass, but batteries demand far tighter specifications. That means more processing, more testing, more rejection risk. Benchmark Mineral Intelligence and industry filings have repeatedly shown a gap between nominal lithium output and battery-grade usable supply. That gap is where price spikes are born. Take the price shock of 2022. Spot lithium carbonate prices in China surged to levels above 500,000 yuan per metric ton before collapsing in 2023. Reuters, Bloomberg, and Fast Markets all tracked the surge and reversal. To most consumers, it looked irrational. Why would a material tied to a long-term energy transition behave like a meme stock? Because this market is still relatively small, opaque, and highly sensitive to marginal disruptions. A delay in South American output, a refinery bottleneck in Asia, or a sudden procurement wave from cathode makers can move the whole curve. But that was only the visible part. The second choke point sits thousands of miles away.
Much of the world's lithium chemical refining capacity, especially for battery-grade conversion and downstream cathode processing, is concentrated in China. The International Energy Agency has estimated China's share of refining for battery minerals at dominant levels across several materials. And for lithium refining specifically, it has been around 2/3 to 3/4 in recent years, depending on methodology and year. That concentration matters because carbonate often does not end its journey where it starts. It travels to be upgraded, blended, or converted into hydroxide for nickel-rich cathodes. So the route is not simply Chile to car. It is brine to pond, pond to carbonate plant, carbonate to port, port to vessel, vessel to Asian refinery, refinery to cathode producer, cathode to cell plant, cell to automaker. 1 weak link, and the cost of the finished battery starts drifting upward. Ask yourself, how many buyers of electric cars know their sticker price is shaped by a chemical relay race across deserts and oceans? There is another layer people rarely discuss: water. In the Atacama, extraction has long faced scrutiny over hydrological impact and community tension. Chilean regulators, local communities, and environmental researchers have all pushed harder questions about brine extraction, freshwater use, and ecosystem stress. Even where companies comply, the political risk rises. Permits slow. Expansions get negotiated. Operating assumptions become less certain. A supply chain hates uncertainty almost as much as it hates shortage. And this is where my own view gets sharper. I do not think the market has fully priced the social license problem. Investors can model ore grades and freight rates. It is much harder to model what happens when local resistance, water constraints, and national industrial policy collide in one basin. That is not a side issue. It is the root. Then shipping enters the story. Lithium carbonate is not the highest volume bulk commodity on Earth, but it moves through a logistics system built on reliability. Containers, bulk chemicals, port handling, customs paperwork, hazardous material compliance, depending on form and route, and vessel schedules all matter. During the pandemic supply chain breakdown, ocean freight from Asia to the US became the famous headline. Less visible was the lesson it taught commodity supply chains. Small disruptions in a stretched network can create outsized price effects when inventories are thin. Battery chemicals learned that lesson too. If a shipment misses a vessel in northern Chile, or if conversion schedules in China slip, or if a cathode producer has to buy spot tons instead of contracted tons, the cost ripple can move fast. Not because lithium is the biggest part of a battery by weight, but because it is a strategic input with limited substitution once a chemistry plan is set. The battery pack can account for roughly 30 to 40% of an EV's cost, depending on model and year. Even if lithium itself is only part of that bill, volatility in lithium chemicals can still swing margins, procurement strategy, and launch timing. But wait, the most important twist is that the bottleneck is not always physical shortage. Sometimes it is mismatch. The wrong chemical in the wrong place at the wrong purity at the wrong moment. Carbonate may be available, but a cathode line needs hydroxide. Material may exist, but not in battery-grade form. A project may be producing, but not yet qualified by downstream customers. In commodity markets, that difference is everything. This helps explain why headlines can say lithium oversupply, while manufacturers still complain about tightness in usable battery material. It sounds contradictory. It is not. It is the same reason crude oil abundance does not automatically mean cheap jet fuel at every airport. Processing configuration decides who actually gets what they need. Now, add geopolitics. The US, Europe, and allies want more local battery supply chains. The Inflation Reduction Act in the United States pushed sourcing incentives. The EU has moved with its critical raw materials agenda. Everyone wants resilience. But building a mine is slow. Building refining is slower. Qualifying battery chemicals is slower still. You can announce a billion-dollar plant in one press release. You cannot compress electrochemistry and customer qualification into a quarter. Time is the hidden tax here. That is why this single route matters right now. South American brine output is expanding, yes. Direct lithium extraction technologies are being tested, yes.